Hey, it's Tom here and welcome back to the channel. So I had a pretty good response to the last video I uploaded on the channel, which was all about Warren Buffett's best investments. It was a bit of a celebration of his birthday. He just turned 91 at the end of August 2021 and had a good comment on that video actually suggesting that I do a Warren Buffett's worst investments video on the channel as well. So that is going to be this video. You might be surprised actually to hear that Warren Buffett has had quite a long list of investment mistakes. Even the greatest investor of all time gets it wrong from time to time, and in this video I want to look at really two of those examples in depth. Two quite different types of mistakes as well, and just like in the Warren Buffett's best investments video, I want to also give a bit of an honorable mention to a third investment mistake in this video. So if you like the video, please hit like on the video and also hit subscribe. Like I've mentioned in a few recent uploads, I'm going to be giving away a copy of Poor Charlie's Almanac back here at 30,000 subscribers. So if you could help us sort of keep nudging towards that goal, that would be very much appreciated. But for now, let's get straight into the video. Okay, so the first investment mistake we're going to be talking about in this video is actually probably Warren Buffett's most spectacular flop that he's had through his entire investment career, and that is in a business by the name of Dexter Shoes. Now, I'm going to read some extracts from a few different Warren Buffett shareholder letters over time so that you can kind of get a feel for how Warren Buffett's perspective on Dexter Shoes changed and kind of what went wrong with this investment. So this was an investment made by Buffett through Berkshire Hathaway back in 1993. He actually, interestingly, paid for the business using Berkshire Hathaway stock. Like we talked about in the last video, Buffett has been quite good at sort of strategically either issuing shares to buy businesses or to buy back shares in Berkshire Hathaway, depending on sort of the valuation of the company at the time. So Buffett did end up issuing shares in 1993. Buffett issued 25,203 Class A shares, which represented about 1.6% of the company, or about $433 million in stock at the time. And this is what Buffett had to say about Dexter Shoes immediately following that acquisition in 1993. So this is an extract from the 1993 shareholder letter. He said, Dexter's business includes 77 retail outlets located primarily in the Northeast. The company is also a major manufacturer of golf shoes, producing about 15% of the US output. Its bread and butter, though, is the manufacture of traditional shoes for traditional retailers, a job at which it excels. Last year, both Nordstrom and JCPenney bestowed special awards on Dexter for its performance as a supplier during 1992. Our 1993 results include Dexter only from our date of merger, November 7th. In 1994, we expect Berkshire's shoe operations to have more than $550 million in sales, and we would not be surprised if the combined pre-tax earnings of these businesses topped $85 million. 5 years ago, we had no thought of getting into shoes. Now we have 7,200 employees in that industry, and I sing, there's no business like the shoe business as I drive to work. So much for strategic plans. So there you have it. From the man himself, Warren Buffett had a very, very rosy outlook for Dexter immediately following the acquisition. It's worth noting that Dexter isn't the only shoe business that Berkshire owned at the time. They actually acquired another shoe business a couple of years earlier called H.H. Brown, so the numbers sort of quoted in that letter immediately following the acquisition aren't just for Dexter, it's for the overall sort of Berkshire shoe business. But things changed pretty dramatically. So if we fast forward from 1993 when the acquisition was first made through to 1999, sort of the tone in which Warren Buffett writes about Dexter in his annual letters is very, very different. So he said, almost all of our manufacturing, retailing and service businesses had excellent results in 1999. The exception was Dexter Shoe, and the shortfall did not occur because of managerial problems in skills, energy, and devotion to their work. The Dexter executives are every bit the equal of our other managers. But we manufacture shoes primarily in the US, and it has become extremely difficult for domestic producers to compete effectively. In 1999, approximately 93% of the 1.3 billion pairs of shoes purchased in this country came from abroad where extremely low low-cost labor is the rule. And that threat of low-cost labor basically completely explains this mistake and sort of the failure of Dexter Shoes. It was just an outside factor that Warren Buffett failed to consider, and like he said in his early letter, the bread and butter business of Dexter was to supply, everyday kind of shoes to retail stores like JCPenney. So this is not some high-end fashion shoe producer where they have a really strong brand and people are willing to pay big premiums to buy those shoes. This is very much a commoditized kind of area of the shoe market. And anytime that you have foreign competition come in that can produce shoes for far, far cheaper than they can do it in the US, that's a massive threat to the business, in this case Dexter, and it really just absolutely killed its profitability. Now, if we fast forward 2 more years to the 2001 annual shareholder letter from Warren Buffett, things had gotten even worse, and this is what he had to say about the business. So he said, our shoe operations included in other businesses lost $46.4 million pre-tax, with profits from H.H. Brown and Justin swamped by losses at Dexter. Now, one of the things I've always appreciated about Warren Buffett, aside from the fact that he's the GOAT and has like the best investment track record of all time, in my opinion, is the fact that he's always been very open and kind of honest about his mistakes. And he went on in this 2001 letter to say that he has made 3 decisions relating to Dexter that have hurt you, being in this case the Berkshire shareholders, in a major way. 1, buying it in the first place. 2, paying with it for stock. And 3, procrastinating when the need for changes in its operations was obvious. I would like to lay these mistakes on Charlie, or anyone else for that matter, but they were mine. Dexter, prior to our purchase, and indeed for a few years after, prospered despite low-cost foreign competition that was brutal. I concluded that Dexter would continue to cope with that problem, and I was wrong. And finally, if we fast forward a further 6 years to the 2007 shareholder letter, Warren Buffett goes on to say, finally, I made an even worse mistake when I said yes to Dexter, a shoe business that I bought in 1993 for $433 million in Berkshire stock, or 25,203 shares of Class A. What I had assessed as durable competitive advantage vanished within a few years. But that's just the beginning. By using Berkshire stock, I compounded this error hugely. That move made the cost to Berkshire shareholders not $400 million, but rather $3.5 billion. In essence, I gave away 1.6% of a wonderful business, that being Berkshire when he issued these shares, one now valued at $220 billion, to buy a worthless business. And if you actually fast forward to 2021, those 25,000 or so shares of Class A are actually no longer worth $3.5 billion. They're actually worth $10.8 billion. So I've heard Buffett talk about mistakes a couple of times. I know he got into some sort of like gas station venture when he was very young, I think still a teenager even, and he said that the opportunity cost of that mistake of losing like a couple of $1,000s or something at the time was massive. It was billions of dollars today because he's compounded so greatly over time, and we're seeing that exact same thing with Dexter in this example. So that is the first mistake we'll talk about in this video. Probably Warren Buffett's biggest ever just complete flop. The speed at which Dexter Shoes just got annihilated by foreign competition is pretty astounding. And it's one of those ones that, people that use investment checklists all the time, maybe someone like a Guy Spear or a Monesh Prabrai, I would almost bet that they have something along the lines of, is this business at risk of being annihilated by foreign competition on their checklist? And I expect that's probably come from the Dexter Shoe example. Maybe a more modern example of that would be, does this business have Amazon risk? Can Amazon, just wipe out that particular business? Because that has been a threat for a lot of retail stores these days. But it's a really interesting case study from Buffett, one that he just flopped on pretty hard, to be honest. And it cost Berkshire shareholders around the $400 million, but if you look at the opportunity cost of what that stock is worth today, it is a much larger number than $400 million. Okay, so the second mistake I want to talk about from Warren Buffett is quite a different example to Dexter Shoes, and that is actually his bet on airlines. Now, airlines for Warren Buffett are kind of like this pesky ex-girlfriend. It's been a very sort of ongoing on and off relationship that Warren Buffett has had with airlines. And he's said some pretty famously, negative things about investing in airlines. He initially actually made an investment in US Air in 1989. That's sort of the first record that we have of Warren Buffett making some sort of airline investment. He didn't actually buy the stock directly in 1989. He actually bought convertible preferred stock, and as he described it, they just barely got out of it alive. The business almost went into bankruptcy, and even though they had preferred stock and were sort of higher up the ladder in terms of getting their dividends paid first and all that sort of stuff, they were kind of almost dragged into bankruptcy, and they kind of just scraped through that by the skin of their teeth. And Warren Buffett has even joked in the past about, anytime he feels like he might want to make an investment in an airline, he has a 1-800 number that he can call, and he says, "Hello, my name's Warren Buffett and I'm an airaholic," and they talk me out of it. So he's been very negative about airlines over time. But interestingly, he actually started to buy into a basket of the airlines in 2016. And just before we get into the bet that Buffett made in 2016 on the airlines, I just want to read a section from the 2007 shareholder letter. These shareholder letters are absolute gold when we're talking about investment mistakes. And this was one that he actually interestingly wrote before he made the investment mistake that we're going to talk about from sort of 2016 through to 2020. So in the 2007 annual letter, Warren Buffett said, "Now let's move on to the gruesome." And this is where he's talking about sort of types of businesses that are sort of the good, bad, and the ugly. So he's moved on to the gruesome, and he says, "The worst sort of business is one that grows rapidly, requires significant capital to engender the growth, and then earns little or no money. Think airlines. Here, a durable competitive advantage has proven elusive ever since the days of the Wright brothers. Indeed, if a far-sighted capitalist had been present at Kitty Hawk, he would have done his successors a huge favour by shooting Orville down. The airline industry's demand for capital ever since that first flight has been insatiable. Investors have poured money into a bottomless pit, attracted by growth when they should have been repelled by it. And to my shame, I participated in this foolishness when I had Berkshire buy US Air preferred stock in 1989. As the ink was drying on our cheque, the company went into a tailspin, and before long our preferred dividend was no longer being paid. But we got very lucky. In one of the recurrent but always misguided bursts of optimism for airlines, we were actually able to sell our shares in 1998 for a hefty gain. In the decade following our sale, the company went bankrupt twice. To sum it up, think of 3 types of savings accounts. The great ones pay an extraordinarily high interest rate that will rise as the years pass. The good ones pay an attractive rate of interest that will be earned also on deposits that are added. Finally, the gruesome account both pays an inadequate interest rate and requires you to keep adding money at those disappointing returns. So there really is a lot to kind of not like about the airline industry. You've got a hugely capital intensive business. To a large extent, your competitors or your dumbest competitor kind of sets your price. It's a little bit of a commoditized business in that way. And the other thing that's interesting with airlines is actually that oil prices have a very, very significant impact on the profitability of an airline in any given year. If oil prices go up a lot, that can really hurt profitability or even cause the airline to lose a lot of money. And if oil prices go down a lot, they can become actually quite profitable businesses. Now, if we fast forward to 2016, Warren Buffett actually made the really interesting move, interesting because of the stuff that he'd said back in 2007 that we just looked at. He made the really interesting move to start buying up some of the big 4 airlines. So he started buying American Airlines, Southwest Airlines, Delta Airlines, and United Airlines. And over a few years, he actually built up a stake to around roughly 10% ownership in each of those big 4 airline businesses. And when it comes to investing in some of these airlines, Warren Buffett actually wasn't alone in terms of the list of super investors that were in these businesses. We actually had David Tepper, we had Bill Miller, who was actually in airlines very early and is still somewhat bullish on airlines. We had people like Lee Ainsley, and we actually had Monish Pabrai was investing not in the full basket, but in Southwest Airlines specifically. He actually got out of Southwest before the 2020 pandemic hit and caused a lot of those airline stocks to crash. He was out of it a year or 2 before that, I think, and had kind of moved on to other things. But there were actually quite a long list of investors that were kind of in those airline stocks. And the thesis basically was that there had been quite a bit of consolidation across the industry to the point where there were no longer a lot of small smaller kind of dumb competitors running around setting sort of irresponsibly low prices, I guess, and really putting down pressure across the industry on profitability. You also had the actual stocks kind of going sideways or down for quite a period of years, and it was pricing the businesses at a point where Warren Buffett, he actually mentioned this in I think his 2020 annual meeting after he'd got out of these stocks. It was pricing them at a point where Buffett felt that he could get a admittedly lumpy, but over the long term, probably about a 10% per year cash flow yield. And keep in mind that, we're in a situation where interest rates are very close to zero, and anytime that you can get a 10% free cash flow yield, even if it is a little lumpy, that's very, very attractive relative to just sitting in T-bills for a long period of time, earning basically zero and really not even moving ahead at all after you account for inflation. And for a little while there, it was actually working out okay. These businesses were kind of chugging along from 2016 through to the start of 2020, earning reasonable cash flows. Again, admittedly lumpy, and I'll put some screenshots up here of kind of what those free cash flows looked like for each of these big four airlines over time. But in 2020, kind of everything changed. Obviously, we had the pandemic kick off. We had a massive decrease in the number of flights, not only internationally, but also domestically. And that really, really hurt basically all of these airline businesses. Airlines were at the point where they had a lot of planes simply just sitting on the tarmac. Many of them have a lot of debt on their balance sheet. And in these really capital-intensive businesses, you really need to be operating at or very near to kind of maximum sort of full capacity to make reasonable profits. And anytime that you have a slight dip in revenue, you can become unprofitable. And if you have a really massive decrease in revenue like you did in the early stages of the pandemic, that is an absolute recipe for bankruptcy in these companies. And so in the first quarter of 2021, Warren Buffett made the tough decision to exit completely all of those big four airlines. He exited 100% of his stake, sold every single share across all four of those companies, and took quite a substantial hit relative to the initial amount of money he put in. He didn't pull out anywhere near that amount of money once he got out of these stocks. And the thing that I really wonder about this mistake specifically is whether or not Warren Buffett would make that bet again. Obviously, hindsight is 2020, and it's really easy to see that that was a mistake. If you had been able to see the pandemic coming, clearly you would have known that airlines are not a very good investment, but you would really have to argue, and I would certainly argue, that something like a global pandemic that just kind of shuts down the world and stops all air travel is quite a low probability event in a typical year. And I really wonder whether Buffett thinks about this as investing being a game of probabilities. The odds were stacked in his favor, and he had a low probability event come out of left field and just kind of knock the whole investment thesis over. With something like Dexter Shoes, I think it is much clearer to see that, there was growing international competition, and I think that is something that Buffett probably should have been able to recognize. But with the airlines, I wonder if it was a bet where, the odds were in his favor. He felt that it was a reasonable bet to make with a, relatively small portion of the Berkshire portfolio in the grand scheme, and he just had kind of a low probability event come out of left field and ruin that particular investment. So if I ever got to ask Warren Buffett a question, this would certainly be very high on my list around whether he would be willing to make that bet again if he were presented with the same odds. Now, the third and final mistake that I want to mention is not one of these spectacular catastrophes that shows up as, big losses that Berkshire have taken over time. They're actually the ones that don't show up on financial statements. And Warren Buffett, when you ask him about mistakes, and people have done this plenty of times in Berkshire annual meetings and so on, and again, it's something he's written about in his shareholder letters, the biggest mistakes are the ones that don't show up on the financial statements, and those are the mistakes of omission. They are companies that Buffett knew enough about to make an investment. They were trading at a reasonable price, and he just was, as he describes it, sucking his thumb and didn't do anything. There's quite a long list of businesses that Buffett can probably put in this category. Some of the more well-known ones are Costco. Obviously, Charlie Munger back here was a big-time investor in Costco and still is, and he just couldn't quite get Buffett across the line to make a big position in it. They did own some and have owned it for a long period of time. time. I think they've started selling some recently just this year, but Costco is certainly a really big one, as is Walmart. Berkshire actually started buying Walmart with the aim to get quite a large shareholding in the company, and the price crept up a little bit. He stopped buying and really never got a chance to add to it again. So that was a big miss. And the third big miss that is pretty well known at this point is actually Google. And this again is one that Buffett has spoken about publicly, so I don't think anyone can explain it better than the man himself. So to wrap this video up, I'm going to play a clip at the end of the video with Warren Buffett explaining the mistake that he made with Google. So before we roll that clip, thank you for watching. That is it from me. I will leave it to Warren. Like I say, if you did like the video, hit like on the video, and also hit subscribe so that we can push the channel through to that 30,000 subscriber mark, and I get the chance to give one of you a copy of Poor Charlie's Almanac back here. So thanks for watching. Let's roll the clip with Warren, and I will see you in the next video. Cheers.
I don't mind not having caught Amazon early. The guy is kind of a miracle worker. It's very peculiar. I give myself a pass on that. But I feel like a horse's ass for not identifying Google better. I think Warren feels the same way.
Yeah.
We screwed up.
He's saying we blew it. Yeah. And we did have some insights into that because we were using them at Geico and we were seeing the results produced, and we saw that we were paying $10 a click or whatever it might have been for something that at a marginal cost of them it was exactly zero, and we saw it was working for us. So
we can see in our own operations how well that Google advertising was working, and we just sat there sucking our thumbs.
Right.
So we're ashamed. We atone. We're trying to atone. Maybe Apple was atonement.
When he says sucking our thumbs, I'm just glad he didn't use some other example.
Yeah, that's it. Okay, furniture company, all right. I wonder why they listed on like the stock market, like for such a small company. Like, why would they do that? And then I just opened up their balance sheet. Was the first thing I went to, and I just saw that they had like $60 million of inventory and no debt. And I'm like, well, wait a second, is this business like liquidation? Like technically they've got $60 million of stuff, yet they're selling for $9 million. I'm like, okay, I need to look into this a little bit more.